Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Securing external investment is a key moment in a founder's journey, and it's about much more than just money. Investors, whether they come from angel groups, venture capital, private equity, or strategic partners, look closely at the founder's readiness to lead a bigger, more accountable, and strategically complex organization. Just as buyers assess a business before acquisition, investors evaluate the founder alongside the company. Studies show that a founder's capability, mindset, and readiness are among the top reasons deals succeed or fail. Many startups with strong products struggle to get investment because the founder isn't fully prepared for the new responsibilities and expectations that come with institutional capital. Assessing a founder's readiness helps build investor confidence, since investors invest in teams, not just ideas. A founder who shows preparedness, self-awareness, and clear strategy boosts investor trust, often resulting in better valuations, quicker deals, and more favorable terms. This process benefits both the business and the investors by creating measurable value and reducing risk. Understanding founder readiness is key because it helps align the entrepreneur with investor expectations, including growth targets, reporting standards, and governance requirements. This alignment minimizes conflicts after investment and speeds up execution. It also reduces operational risks, since a prepared founder has systems in place, clear processes documented, and leadership support. So day-to-day decisions aren't solely dependent on them. When founders know the investment process, valuation details, and how cap tables work, they can negotiate confidently and avoid costly errors. Investment often triggers significant growth, so founders who are ready both mentally and operationally can turn that capital into sustained, scalable success. To assess readiness, we look at four main areas: mindset, commercial, organizational, financial governance readiness. Among these, mindset and psychological readiness are often seen as the most important. Founders must be ready to move from working solo with entrepreneurial freedom to embracing accountability, transparency, strategic discipline, and collaborative decision-making, which are all critical in a funded business environment. To assess investment readiness, we look at key indicators like coachability, which means how open a founder is to guidance from investors and advisors. A growth mindset is important too, showing adaptability as the business scales or faces market changes. Resilience is about handling emotional uncertainty, while clarity of purpose involves having a clear, compelling vision that attracts both capital and talent. Another crucial factor is the willingness to relinquish control, which is necessary for building and scaling effective teams and structures. To measure these traits, tools such as mindset assessments, behavioral interviews with investors, and personality or leadership diagnostics like DISC or Strengths Finder are used. Alignment workshops between founders and investors also play a role. When a founder demonstrates openness, strategic clarity, emotional resilience, and a readiness to evolve, they're typically deemed investment ready. On the commercial side, investors want proof the business model can scale and deliver returns. This includes having a clear value proposition, evidence of traction through customers, revenue, and sales pipeline. Understanding the competitive landscape and having a scalable business model with repeatable processes are also vital. Clarity around unit economics and customer acquisition costs matter greatly. Measurement tools like performance dashboards, analytics on customers and revenue, market sizing, and competitive mapping help evaluate readiness. Overall, a commercially ready founder can confidently explain key metrics such as margins, lifetime value, acquisition costs, retention rates, and unit economics. Investment typically requires a stronger team structure, so investors look closely at whether the founder has the leadership skills and the humility to build and empower a capable team. They want to see clear leadership roles beyond just the founder, the ability to delegate tasks well, hiring plans that match growth needs, documented processes and systems that can scale, and a company culture that supports ongoing growth. To evaluate this, tools like organizational maturity assessments, capability gap analyses, people and culture diagnostics, and founder dependency heat maps are useful. Essentially, a business is considered organizationally ready when it can operate effectively without relying solely on the founder. On the financial and governance side, investors expect clean and consistent financial reporting, transparent monthly updates on key metrics, and clear governance structures, such as a board or advisory group. Legal readiness is also important, covering contracts, intellectual property, compliance, and shareholder agreements. Moreover, understanding the investment process, like dilution, valuation, and term sheets, is crucial. These areas are assessed through financial audits or pre-investment reviews, governance, maturity models, and legal readiness audits to ensure the business meets professional standards and is well prepared for investment. The founder's financial readiness hinges on the business being able to pass due diligence without needing major restructuring, especially around the cap table and shareholder setup. Take the early stage SaaS founder, for example. Despite having a strong product, investors pulled back when they found undocumented financials, inconsistent contracts, no clear go-to-market plan, and a founder resistant to feedback. This shows how crucial mindset and governance readiness are. Without them, deals can quickly fall apart. On the other hand, a retail founder preparing for a Series A invested 6 months in building a strong leadership team, documenting standard operating procedures, setting up a data dashboard, and improving investor communication through coaching. This effort helped the business secure £5 million at a good valuation because investors saw a well-prepared founder. Lastly, a deep tech founder transitioning from academia struggled initially due to a lack of commercial mindset, but was able to overcome this through coaching, recruiting a CEO founder, and investor readiness training, eventually securing major institutional funding. These examples highlight that readiness isn't always innate. It can be developed through focused preparation and support. Founder investment readiness assessments offer several advantages that can significantly improve a startup's chances with investors. Being well prepared increases the likelihood of securing funding because investors feel more confident when founders clearly understand their business and the investment process. This readiness also strengthens a founder's negotiation position, as they have a better grasp of valuation, deal terms, and structures, helping them avoid unfavorable agreements. The assessment process encourages a clear strategic focus by defining the company's mission, key metrics, and milestones, which aligns expectations between founders and investors early on, reducing potential conflicts. Additionally, businesses that undergo this preparation tend to scale faster after investment, since they already have the necessary processes, teams, and systems in place to support growth. On the other hand, readiness assessments come with challenges. It takes considerable time, often months or years, to truly become ready, so it's not a quick fix. There are also costs involved, including legal work, financial audits, coaching, and system implementation, which can be significant for early-stage companies. Finally, going through this process can be emotionally demanding, as it requires founders to confront their limitations and adjust their mindset, which can be difficult but ultimately beneficial for long-term success. Founders need to be willing to reflect on themselves, accept feedback, and sometimes give up control, which is often the toughest part of the journey. Preparing for investment can reveal gaps in capability within the team that might mean leadership changes are necessary, potentially causing tension. It's also common for founders to realize during readiness assessments that they are not quite ready yet, which can delay fundraising efforts. Ultimately, being ready for investment is now one of the biggest predictors of whether a business will successfully raise capital and perform well afterward. Investors look beyond just the business opportunity to the founder's mindset, leadership ability, strategic focus, emotional resilience, and capacity to grow a team. A clear, structured assessment that covers psychological, commercial, organizational, and financial readiness helps founders understand where they are strong and where they need to improve. Investment readiness isn't just about preparing the business for capital. It's about preparing the founder for a new phase of leadership and growth. Founders who approach investment with clarity and confidence have a much better chance of attracting the right investors, securing a fair valuation, and building a business that can thrive over the long term. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.